Okay, everybody, here we go. It is me, Gregory Mannarino. It is Monday, April 24th, 2023. I want to cover a few things here with all of you. I also want to respond to some of the feedback that I got from yesterday's video, Markets A Look Ahead, where I discussed this inflationary environment, how it's playing out, and more than likely where it's going to go. Many of you disagreed with me. Many of you agreed with me. But I want to talk a little more about why we can expect an inflationary depression versus a deflationary depression here. I don't believe people have a full understanding of how it works. So I put together a little piece here. I want to read this to you, and we'll get to that in just a moment. But let's start off with the here and the now. The here and the now, just looking over at this market here, nothing major is going on. We have a very big Fed meeting coming up first week of next month. The market is in more or less of a holding pattern because of that, okay? The economic news continues to come in. It's abysmal. It doesn't stop. It's not going to stop here as central banks continue to crush the economy by killing the consumer. You know this. Anyway, looking over here at the stock market, futures are pointing towards a slightly lower open this morning. Trading doesn't start for about 44 minutes from the time I am doing this video blog. The 10-year yield is stable, okay? A lot of effort going in here to keep it stable. This is central banks buying it all. You got the relative strength of the dollar this morning, lower, nothing major, lower nonetheless. Crypto's holding their own, relatively flat. Gold and silver relatively flat. Crude oil relatively flat. That's the situation. Again, it's kind of like a holding pattern, waiting to see what's going to come out of the mouth of the Federal Reserve next week here. It's going to be interesting. I'm going to tell you right now what's going to happen. The Federal Reserve is going to raise rates yet again. It's going to be small. The market's priced that in my view. But it matters what comes out of its mouth. When Powell, Yellowstone, opens his pie hole, and whatever comes out of it, that's what the market's going to be paying attention to. I believe a 25 basis point hike is already priced in here. Okay, we'll see. We'll see how that plays out here. Is anything at all gonna change the way you and I are setting ourselves up for the future here? What do we know is going to continue to happen? The global debt is going to continue to surge. Okay. The Federal Reserve, central banks are on a mission here to destroy the purchasing power of their currency. That's a fact. And there's another element here too. Global de-dollarization. You have to consider what this means here. All right, a lot of people hate the dollar. Even people here in the United States hate the dollar. But as the dollar, I don't want to say loses its reserve status, because I think the only way that's going to happen is via a war. For the dollar to lose its reserve status, it would have to be decoupled from the petrodollar. I don't see that happening for a very long time, or unless there's a war, a global war, which very well could happen here. But what would that mean here? Let's just for a nanosecond take the factor out of the dollar losing its petrodollar status here. The fact of the matter is that the world is in a state of de-dollarization here. So demand for the dollar is going to drop. And what is that? If demand for the dollar drops, what does that mean for inflation? It means you will see much higher inflation here in the United States. You understand, a weaker dollar off the back of that. So again, this plays right into, yet again, the reason why we're going to get an inflationary depression versus a deflationary depression. Now, I want to read this to you. Now, before I start, I want you to get a mental picture of something I have been showing a lot lately here. This chart right here, right off the Federal Reserve's own website, 1913 versus today, the value of the dollar. We are in a literal free fall. and there's no end in sight here. People, this is not going to stop. So keep this in mind. Consider the de-dollarization of the world as well, and think how that's going to play into this. So again, let's just bear with me a moment. Let's cut right to the chase. That chart that I just showed you is off the Federal Reserve's own website, and it demonstrates that ever since the inception of the Federal Reserve System in 1913, the purchasing power of the dollar has been in a steady, dramatic decline. All right, just one more flash of that. Would you disagree? I doubt it. Okay. What this chart also demonstrates is that there's no end in sight. It's not going to stop, especially in light of world de-dollarization here. Collectively, world central banks have been working in concert for many decades to devalue their respective currencies faster. Okay, you know this because I've been telling you for years. Moreover, this process of devaluation is going to accelerate, again, on the back of many factors, which we've discussed a million times. Not only are central banks going to exponentially increase global debt, which requires exponentially more currency creation to buy the debt which they issue, but there is a lag effect. Have you heard this term before? A lag effect? Maybe, because I've discussed it before, but bear with me. Let's look at lag effect. This lag effect regarding inflation is the product of past currency/debt creation, which then takes time to work through the system. Does that make sense to you? I hope it does. Many people believe that the present, pay attention to this part here, okay, it's important. Many people believe that the present inflationary environment is being created by the current economic environment. This is simply not true, people. The current inflationary situation is the result of previously created debt and monetary policy which really kicked off during the last financial meltdown of 2008. The lag effect. It takes a while for this to work its way through the economy. There are many people who believe or are hoping for a deflationary event to occur. Many of these same people point to a rapidly slowing economy and theoretically dramatically falling demand, which will drive prices lower. Let's look at the COVID event, just to put a perspective on this. During the worldwide COVID economic shutdown, did prices fall? No, they didn't. During the worldwide COVID shutdown of the world economy, did stock markets fall as most people expected they would? No, they didn't. Truth be told, I may have been one of the only stock market analysts who said publicly that on the back of COVID, stock markets would move higher, and they did. It's an incredible paradox, isn't it? What people can count on is central banks not allowing a major deflationary event to occur. They won't allow it. Central banks fear deflation more than they fear inflation. Period, people. And this is, among other things, why central banks go out of their way to create inflation. There will be, and already are, parts of the market which are experiencing falling prices. Real estate, for example, which is being offset by food inflation rising at its fastest pace in over 4 decades. Then again, we have more lag effect. You understand? The truth is this. We have yet to see the full effect of massive debt and currency creation which stemmed from the last financial meltdown, and no amount of central bank rate hikes can do a thing about it. Then, of course, we have this global de-dollarization event, which is occurring. Okay, it's not getting the coverage I think it should be getting, but it is occurring. There, again, I mean, nothing would make, let's say, Russia and China more happy than to see the world become less dependent on the dollar. You understand? This should make sense to you here. So, gauging from what I just talked about here, and this lag effect, I mean, there's just central banks, none more so than the Fed, is still creating mountains of debt. They're buying it all. Now, you can go over to the Federal Reserve's website and you can see, or they're going to show you a chart where the amount of cash available seems to be decreasing. This is not true. Okay. In order for the central banks or any central bank to keep the system going, they have to continue to pull cash into the now, find reasons to borrow, to inflate So there is no way that the money supply is contracting. Again, you can go to the Fed's website. They're going to show you a chart. They're going to show you a chart that's going to say, hey, yeah, well, the money supply is in fact dropping. This is not true at all. Has no bearing on reality whatsoever. Central banks must inflate, and they must continually inflate just to sustain the current system, even in its free fall economic environment. You understand? Again, lag effect. And then you got what I believe is going to be a much larger wave of inflation coming at us from multiple factors. Again, we haven't even begun to see the effect of money creation and monetary policy out of the last meltdown. And then again, going back to world de-dollarization, that's going to weigh into this as well. So forget about any kind of a deflationary event. Ain't happening. Mark my words on this. Now, with regard to this thing I wrote up here, if in fact you are a subscriber to my newsletter, link in the description of this video, I'm going to fire this out to every single one of you. Okay, you'll have a copy for your own. So check your email box in about an hour, and you will have this in your email box again if you subscribe to my newsletter. If you have yet to subscribe to my newsletter, it's free. I don't know what you're waiting for. Please do it, and you'll have this as well. All right, people? I love all of you from the heart. I mean that. I hope I covered some important points here with all of you that make sense, okay? With that said, please share the video. Thumbs up, so important. Please, please, please give me that thumbs up. I will see all of you at the end of the day for my live stream, 1:05 p.m. Pacific Standard Time, okay? I'll see you then.